Now let's look at the yield curve and corporate spread. When we talk about the yield curve, we often refer to the Treasury yield curve. Of course, there's a corporate yield curve, but most of the time we are looking at the Treasury yield curve. And this is also known as term structure in a lot of academic research. In layman terms, this is known as the time value of money. If you look at this chart, what we are looking at is we have interest rate here, and we have the maturity spectrum. This part of the curve here is called the front end of the market. This is the back end of the market, and this is the belly of the market. So the longer the maturity, that means the further out we go, the higher the interest rate. Now this makes sense because if you are going to be lending money to Uncle Sam, you're buying the treasury bonds, the further out in time, the more interest you should expect to get. This is why we call this the normal yield curve. So what happens to the curve when the Fed raises interest rate to 2%? So the front end of the curve would move up. It's important to know that the 2-year yield is equal to the average Fed funds rate over the next 24 months. So in this case here, when the Fed had raised rate to 2% on August 31st, 2018, the 3-month yield was at 2%, while the 2-year yield was 2.6%. So the market was pricing in a higher Fed funds rate over the next 2 years. Now, I want you to guess if the 30-year bond yield was higher or lower than the 4% on August 31st compared to December 31st, 2013. As it turns out, surprising to most people, the 30-year yield actually came down. Right? At the time when the front end of the curve yield went up. This is where it's important to know the dominant risk, the dominant factor at these two parts of the yield curve. The front end is dominated by monetary policy. They move according to where the Fed funds rate is moving towards. Whereas the back end of the curve is highly dependent on the market's inflation expectation. When we see something like this, where the front end interest rate move up and the back end interest rate come down, right, we call this curve flattening. So let me run through this one more time because it's extremely important. When we have a normal yield curve in the dark line here, the Fed raise rate and the back end come down, we have a curve flattening. But if the Fed were to raise rate too much, then the back end yield could come down even more. And when this happens, we have an inverted yield curve. The inverted yield curve is very, very important. Whether we look at the 10-year minus 3-month spread or the 10-year versus the 2-year spread. So you can get this chart from the Federal Reserve Economic Database. This is 10-year minus 3 months. This is 10-year minus 2 year. And each time you will see that whenever we have the spread turning negative, meaning we get an inverted yield curve, we bump into this very scary gray bars. What are these? These are recession period. Right? And over the recent years, we have seen that this recession coincide with certain crises. We have the oil price crisis here, and then we have the dot-com bubble bursting, and we have the global financial crisis. It is as if when we have a negative yield curve, the economy, the structure becomes very vulnerable to bad news. Right? And when we have a shock, we have a crisis. And now let's look at the Treasury 10 to 2-year spread and overlay this with the S&P 500 stock index. You can see here when we have this 10 to 2-year spread turning negative, meaning we got an inverted yield curve, the stock market rally for a while before it sells off. And similarly here, we have a negative spread, stock market rally for a while before it sells off. Why? Well, the reason for this is connected to the banking system. And here, we want to look at how the bank calculate its net interest margin. Net interest margin is equal to net interest income minus net interest payment. And where does the bank get the income from? Well, largely from mortgage loan. The mortgage loan, in general, is tied to the 10-year Treasury bond yield. Let me say this again. The mortgage loan, right, the 30-year fixed mortgage, is tied to the 10-year Treasury yield. What about the cost of fund for the bank? Well, their net interest expense comes from the deposit or savings account, which is the front end of the curve. This is the amount of interest that the bank pays us when we deposit money with them. So the difference between the interest rate they pay us and the interest rate that they receive from giving out mortgage loan, this is the bank's net interest margin. When we have an inverted yield curve, the numbers change dramatically because now the cost of fund, the net interest expense, has turned higher than the income that the bank receives. So this means that for every new loan that the bank gives out, they're losing money. They're paying more for the deposit than the interest that they receive from granting the mortgage loan. So why would the bank do that? The answer is they would not. Right? They would want to hold back on all loans until such a time when the curve normalize again, where interest rate in the front end come down. So when banks stop giving out mortgage loan, what happened to the housing market? Less people buy houses. What happened to the furniture industry? And so on. Right? So you see the ripple effect. Right? When the housing market slows down, it ripples on to the other part of the economy, and the economy would just slow down, and we get a weaker GDP, and we get a weaker stock market. So remember this, When you think about a yield curve, always ask yourself the question, will the banks be interested in giving out mortgage loans? This is a chart to show you that residential mortgages are linked to the 10-year Treasury. Commercial real estate loans are connected to the 3-year, auto loans to the 2-year. Home equity loans to the 3-month yield, and CNI loans connected to the 1-month interest rate. Well, we have talked about the curve flattening, and we have talked about an inverted yield curve. So what could make the curve steepen? Here, we are looking at a bearish steepening scenario. Why is it called bearish? Well, you can see that interest rate move up. When interest rate move up, bond prices drop. Bond prices drop, there's a bear market for the bond people. So this is a bearish steepener. Steepener means that the back end interest rate goes up more than the front end. Typically, this is when the Fed were raising interest rate very slowly and the economy is running way too fast and inflation is escalating. That's why the curve steepened. On the flip side, we can also see bullish steepening every now and then. Right? Why is it bullish? Well, interest rate have fallen from here to here. Lower interest rate, bond prices go up. That's good for the bond market. That's bullish. Right? And this happens when the Fed cut rates rapidly, but the economy is too sluggish and inflation is falling very slowly. That's why we have the curve steepening. And this is when the front end interest rate drop more than the back end. Typically, whenever we see a curve steepening, the market will say that the Fed is behind the curve. That means that they're not doing enough to change the momentum in the economy. A curve steepening situation is very good for the bank stocks. Here you see the blue line represent the yield curve and the red line represent the bank's stock as a function of overall index. So here you look at the blue line, when the curve steepens, banks outperform the overall index. So investors tend to want to buy bank stocks when they believe that the yield curve is steepening, which makes sense because when the yield curve steepen, what happened to the net interest margin? Wider, right? That means that the banks can make more money. Now let's look at the corporate bond spread. We have our treasury spread here. And on top of the treasury security spread, on top of the treasury security yield curve, we have the double A corporate bond, and we can have the single B and triple C, right, and so on. Right? The difference is the credit spread. Why? Because if I am holding a treasury bond here and I am thinking of selling my treasury bond to buy a corporate bond of similar maturity, I need to be paid an extra spread because I am giving up good credit for something that has higher credit risk. Right? So in times of crisis, this spread would widen because investors need to be compensated for the greater risk they are taking. So here is another factor where the Fed have to consider, right, when they formulate monetary policy. In a recession, the Fed can cut rates, but they also need to understand that if they cut rates, we have interest rates falling here. But if the double A or the single A or double B interest rate were to move up, because investors are more fearful, the spread widen, right? This means that investors are now demanding a higher interest rate. It also means that it now costs the borrowers more money when they borrow, even when the Fed has cut rates, even when the Treasury yield has come down. So there are 5 main considerations for monetary policy. First, money supply, right? Our MV equals PT, right? M, right? What's the Fed doing to money supply? Are they pumping in more money to the system, or are they withdrawing money from the market? Then velocity. Velocity, right, is how often you open your wallet. Are the money circulating? Uh, are the people spending money? Are companies hiring? Are banks willing to give loans? These are all velocity, right? Remember that within velocity, the major components are bank loans, right? The Fed cannot operate on its own to influence the economy. The Fed need the banks to lend money. Okay? Otherwise, whatever the Fed is doing, it cannot transmit to the economy. Then we have the Treasury yield curve. Right? If the curve is inverted, that is also connected to the bank loans. Then finally, corporate bond yield spread. Okay? If the spread widen, there's more fear in the system, then whatever the Fed is doing is not enough to influence or specifically to lower the borrowing costs for corporation. And if corporation cannot find a lower borrowing cost, that makes the recession a lot worse. This concludes this segment here.